Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS research team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the grains, Mark Soderberg, what are your expectations for Friday's USDA production and WASDE reports?
Yeah, hi, Jeannie. Well, I look for the USDA to cut both their corn and soybean production forecasts. In corn, I've got production at 16,435,000,000 bushels, and that's down 379 million bushels from the USDA forecast in September. I've got an average yield at 182.5 bushels per acre. That would still be a record high, however, off the USDA estimate of 186.7 back in September. On the demand side of the equation, we continue to be flying a little bit blind here as it comes to the exports with the federal government shutdown. However, U.S. FOB offers do remain very competitive in the global marketplace, so I think exports are going to hold up. I've got usage for ethanol up a little bit as the weekly production rates have been pretty strong here as of late. However, on feed usage, I look for the USDA to lower this by 200 million bushels to 5.9 billion bushels as U.S. cattle inventories have been slow to build with that screwworm problem in Mexico, keeping the border closed to feeder cattle imports. So all told, I've got lower production combined with lower usage, so very little change in ending stocks. I'm at 2.112 billion bushels. In the soybeans, I look for production there slipping 61 million bushels to 4,240,000,000. That's with an average yield of 52.8. That's still a record here as well, but below the USDA forecast from a couple months ago at 53.5. Given all the uncertainty with the trade deal with China, I still think the USDA is going to have to lower that export forecast. I'm down at 100 million bushels to 1.585 billion. I've got crush up a little bit, and as a result, ending stocks, I've got them at 323 million bushels, up from the September forecast. The USDA had them at 300. In wheat, I look for a slight upward revision to ending stocks just due to the higher production figures that we got at the end of September. I've got ending stocks up about 40 million bushels to 885, which, if realized, that would be a 6-year high.
Thanks, Mark. As China redirects their soybean purchases to Brazil, is the recent price rally sustainable?
As a fundamental analyst, I find it very difficult to answer that question with a yes. That prices can go much higher if we don't start seeing better evidence of Chinese demand for U.S. soybeans very soon. I think is what it's going to take to extend this recent rally. China has yet to publicly acknowledge that they have agreed to purchase 12 million metric tons of U.S. soybeans here through the end of the year, and another 25 million metric tons each year over the next 3 years. This, as the Trump administration has been stating. Soybean prices now are up $1.25 from the late summer low on speculation that China would be buying U.S. beans and perhaps on fear for slightly lower production here in the U.S. But with the price surge, FOB offers now in Brazil are below that of what's available here at the U.S. Gulf through the end of January, and that gap becomes much wider once we get into February and Brazil's harvest is underway. So in case even before we factor in this 10% tariff differential that favors Brazil, Brazilian beans are much cheaper going into China. So to me, the upside is limited until we see better Chinese interest in U.S. beans or some sort of a weather problem in South America, which right now just isn't the case. Although we're flying blind with no updates from the CFTC, I'm guessing that since the late September, the last report from the CFTC, speculative traders have covered what was a short position of about 30,000 contracts and flipped that now to there being long, probably just under 100,000 contracts. So and if realized, that would be the largest in almost 2.5 years. So right now I'm seeing the upside is somewhat limited.
All right. Moving over to Mark Bowman. Has the bullish psychology in the coffee market shifted?
It's hard to say yet. We saw the market go to contract highs ICE certified stocks fell to their lowest levels since March 2024. This all based on those 50% tariffs on the Brazilian coffee imports. Stocks are still down around down to 417,000. They fell 14,250 last week. There's been no word in the last couple of weeks over the U.S.-Brazil tariff talks. If there's anything towards towards a movement and lifting those tariffs. The Supreme Court held arguments last week over the legality of the tariffs, so we're kind of on hold here. If they were to decide that the tariffs were not legal, or that Trump stepped beyond his abilities, what he's empowered with, by doing that, that could open up a lot of shipping of Brazilian coffee into the U.S. In the meantime, there has been some movement of moving coffee to those stock to Europe. There were reports last week that 150,000 bags were heading towards Europe into ICE warehouses, and there were ideas that maybe 60,000 would reach in time for delivery against the December contract, which expires on December 19th. We also have seen some movement in ICE stocks from the exchange. They're getting more submitted for grading now. The amount pending review fell to 0 on October 27th, and as of Friday, they had reached 17,184 bags. They're all located in Antwerp, and of those, 11,934 were from Brazil. Now, Brazil certified stocks at this point stand at 13,976 bags versus 435,283 a year ago. So Brazil represents almost nothing. So does this mean that that Brazil is holding back on selling because they don't know what the future holds for the U.S. and if they don't want to sell until they get some sort of more ending or conclusion on this whole tariff situation? We'll have to see on the psychology, but we could be heading in something with the tariffs and with this movement of stocks.
Okay, let's move over to the energies. What bearing does the waiver granted to Hungary from the sanctions on Russian oil have on the crude oil market?
Well, at first glance, it doesn't seem like it would have that much. I mean, they're just one small country. It could be Trump, conceding to a friend after hearing his plight over their situation there, really having a minimal effect on the global oil market, and will do little to support Putin's war. But on the other hand, you have to wonder what Chinese President Xi and Indian Prime Minister Modi think about this. They've been holding back since this latest round of sanctions, and they may start to think, well, maybe it's time to start reconsidering buying Russian crude, or at least thinking about it. And what about the rest of Europe, for that matter? Because they also might start saying, well, why do Hungary get favor and we don't? There's news over the weekend that the Kremlin is planning a trip for Putin to India in December, and that question raises, well, will this put Modi in a bind, or will it give him some clout in negotiations with the U.S.? There's been no comment on India from that meeting, but this may start to grab the headlines. There's also all this floating storage reportedly in Southeast Asia. Now that, especially since India and China have slowed their buying of Russian and Iranian crude over the last several weeks, that's hanging out there, and that weighs on supply. And you got the IEA calling for a huge surplus next year, oversupply of some 4 million barrels per day, nearly 4% of global demand. So there's supply out there, and the question is, whether at what point will that pressure the market?
Thanks, Mark. Lastly, moving over to JP, do you think the Reserve Bank of Australia is done cutting rates?
Bottom line up front, yes, it does seem likely that the RBA is done cutting rates, especially after its easing cycle was only 75 basis points. Last week, the RBA unanimously voted to leave its official interest rates on hold at 3.6%, and they also published upwardly revised forecasts for inflation that suggests price pressures there are going to remain well into next year. The RBA said it doesn't see core inflation returning back to its 2 to 3% target until mid-2026. It also expects to trim mean inflation to reach 3.2% by the end of the year. That's up from the current 3% and a sharp upward revision from the previous forecast of 2.6%. Recent data did show a surprise jump at prices Headline inflation, which ran at 3.2% at the end of Q3, is now seen peaking at 3.7% by mid next year, in part due to the expiration of some electricity rebates. The RBA also said expects the labor market to remain steady, projecting the unemployment rate to remain at 4.4% over the coming years after recently ticking higher to 4.5%. Additionally, a speech by RBA Deputy Governor Andrew Hauser on Monday laid out the central bank's thinking, and none of it is pointing to a further lowering of interest rates in the near future. Hauser said limited spare capacity in the economy meant that the central bank might find itself boxed in with little room to lower rates. He did present a few scenarios that could emerge over the coming months, but his speech mainly fixated on the issues of higher than expected inflation, weak productivity growth, and diminished spare capacity. In my opinion, and I'm sure this is common thought, is that it will take a huge spike in the unemployment rate to trigger the RBA to lower rates. Unemployment rate, like I said, currently around 4.5% and appears to be stable. The RBA also has repeatedly signaled it's more worried about inflation running out of control than it is the labor market.
All right, JP, final question. Why is this week's employment and GDP data important for the Bank of England?
Yes, so a little bit of context. The Bank of England held rates steady last week in a tight 5-4 vote, while comments from the governor, Andrew Bailey, signaled that December's policy decision will be dependent upon upcoming inflation and employment data. Bailey said that he had felt overall inflation risks had moved down, although he did want to assess further data, shifting the focus to upcoming inflation and jobs data for October, November, as well as this week's GDP data, which will be pivotal in determining how the bank's going to move come December. The central bank said that if progress on disinflation continues, the bank rate is likely to continue on a gradual downward path. This is a notable change from previous statements that had championed a cautious and gradual approach to easing. Policymakers there said they felt that CPI inflation has peaked and that underlying disinflation is progressing, helped by a still restrictive policy stance, softer pay growth, and easing services inflation. Inflation lasted at 3.8% in December. That was unchanged from August reading, and notably the month that the bank had expected inflation to peak. So for the data front, evidence of a subdued economy and weakening labor market, especially in regards to wage growth, is going to reinforce disinflation expectations and provide the Bank of England with a much easier path to cut rates.
All right, great. Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.